Welcome to Conversations on the Future of Democracy, a series sponsored by the John W. Kluge Center at the Library of Congress. My name is John Haskell, director of the Kluge Center. We wish to acknowledge the Peter G. Peterson Foundation for co-sponsoring this event and for the continued support they give the Library of Congress. Today, our topic is fiscal policy in the wake of COVID-19. I'm joined by Jason Fichtner, Senior Lecturer and Associate Director of the Masters of International Economics and Finance program at Johns Hopkins University's School of Advanced International Studies. Previously, Jason was a Senior Research Fellow at the Mercatus Center at George Mason University. He served in several positions at the Social Security Administration, including Acting Deputy Commissioner of Social Security, Chief Economist, and Associate Commissioner for Retirement Policy. He also served as senior economist with the Joint Economics Committee in the United States Congress. Jason, welcome.
Thank you for having me, John. I appreciate it.
Well, we're just going to launch right in and talk about the situation with the economy given the pandemic. The pandemic has thrown us into a devastating economic downturn. How does this compare to the Great Recession? Do kind of a compare and contrast.
Well, I'm often asked to do that comparison, and people ask, are we in a recession? Are we in a depression? And I think it's important we start off with an old joke amongst economists that a recession is when your neighbor loses his or her job, and a depression is when you lose your job. And all joking aside, though, at the moment, I don't think we're in a depression, but we are definitely experiencing a major economic downturn that is worse than the 2008 Great Recession. And it's important to recognize that the current downturn is caused by a health shock, a pandemic, and a government policy response to the pandemic, as well as consumer responses to the pandemic, where both the Great Recession and Great Depression were caused by different economic factors. This downturn is definitely different in the nature of how quickly economic activity ceased and how quickly people were separated from their jobs, either through layoffs or through furloughs. And just to give you some perspective on this, the unemployment rate during the Great Depression reached 25%. During the Great Recession of 2008, the unemployment rate reached 10.6%. And under the current recession, we hit a peak of 14.7% this past April. And now we're somewhere around 11 to 12%. Keep in mind that the unemployment rate in February was 3.5%. We've lost as many jobs in the past few months as were created in the last decade. And don't forget the speed at which this happened. The unemployment rate rose faster under the first three months of the COVID health pandemic than in the entire 2 years of the Great Recession. This has also created a major administrative burden on the nation's unemployment insurance system, where state-run systems were never designed to handle this many claims in such a short period of time.
So you mentioned unemployment insurance. What has that achieved? And I know there's a deadline coming up this month as to the continuation of the current level of benefits. What's going on with that? Is it important to continue, in your view, important to continue that level of benefits, or should changes be made?
So the unemployment insurance system is one of our great social safety nets. It actually is designed in a typical manner of an insurance policy. And when you think about insurance, and it's important to have a little quick discussion of this, insurance is there for basically low probability but high cost events. You insure your house against fire, your car against accidents. They're very, very low probability of happening, but they do happen. The cost is great. The same thing goes for unemployment insurance. Most of us don't think we're going to be unemployed at some point in our lifetime. But if we are, the cost is very, very high. So we do some sort of insurance policy for it. And doing this in a social insurance scheme is very important. So our UI system needs to be strong. This was never designed for this level of economic inactivity and this level of unemployment. And during the 2008 Great Recession, they expanded unemployment by the number of weeks in which you qualified. Usually you get 26 weeks of unemployment if you're laid off. In a recession, that can be expanded to 52 weeks for 1 year. During the Great Recession, it was expanded to 99 weeks, so almost 2 years in which someone could have drawn unemployment benefits. Currently, as part of the CARES Act, the unemployment insurance benefit level was increased, and across the board, $600 supplemental weekly increase. That expires at the end of this month, the end of July. The UI system will say that the question is whether or not you need to expand or continue the $600 weekly supplement. Under the current system with the $600, though, we've been finding that about upwards of 2/3 of recipients are actually earning more or taking home more with the unemployment insurance benefit than they were making in their previous job. That's 2/3 of people then who have a disincentive to go back to work. And a lot of people have been concerned, both employers and some members of Congress as well, about keeping those benefit levels so high that it creates a disincentive to go back to work and may stall the economy from recovering. So I do think it's important that we don't just shut them off. There are people who need these benefits, but $600 may be too high. So maybe we should think about how we ramp them down, go from say 600 to 400 to 300, 200, 100, reduce the weekly benefit by $100 or so, or $200 every month or two until they basically expire at the end of the calendar year, and then reassess where we are. If we're short for time because Congress is on recess, and when they come back, there's going to be a little bit of time before the August recess, we could just do an expansion for 1 or 2 months and see where we are in September.
So in general, that aspect, one aspect of the CARES Act had to do with unemployment insurance, and the CARES Act was meant to deal with a lot of other things. So from your perspective, what was it meant to do when you look at it in the big picture, and is it working?
So it's also important to keep in context what not only the CARES Act was and what it did, but how different the policy responses had to be from, say, the Great Recession of 2008. In the Great Recession, people didn't have money to spend or didn't want to spend money. Whereas in the beginning of this pandemic, people couldn't spend money because businesses were forced to shut down. This requires a different set of policy responses. And the CARES Act was designed to get money out quickly for those who needed it. And the CARES Act is not without its fault, but the idea was to act quickly to provide much needed fiscal support to those businesses and individuals who needed it through loans, grants, direct payments, and support for state and local governments. Again, without some hiccups, we've talked about some with the UI system. I do think the expansion was worthwhile. I also think something like the Paycheck Protection Program, which again had some hiccups, but I think was really good policy and did work to keep businesses afloat and people employed. But again, they weren't without some unintended consequences, and those things need to be discussed as we think about what to do going forward.
None of us has a crystal ball, of course, but I'm curious what you think the recovery might look like, or I guess some would argue maybe it's already beginning, but maybe not, particularly if there's a second wave. So what might the recovery look like? In particular, you made the comparison to the Great Recession and the Depression. Since there are different causes for this downturn, is the recovery going to look substantially different? And of course, people would be interested in knowing how long you think it will take. Are jobs going to come back? I mean, I've just hit you with about 5 different questions.
Yeah, and again, I don't know if it's the old Yogi Berra joke, but again, predictions are hard, especially when they're about the future. But this is a really key question, John, and I'm glad you've asked it, because in some ways, we've already seen an amazing rebound and recovery. Look at the stock market. It cratered by 1/3 and basically now is back up. The NASDAQ is at a new high. So from the stock market perspective, if you had gone to sleep for 3 months and woke back up, you wouldn't have known anything had happened. This looks like what's called the so-called V-shaped recovery, where you have a giant decline and then a spike back up. But we're still also at an unemployment rate today that is higher than the peak of the Great Recession. And this gets back into the jobs discussion. So what I think the recovery looks like from here is flat until we find either a treatment or a cure or a vaccine for COVID. Again, this is a different sort of recession. It's caused by a pandemic, not by other supply chain issues or irrational exuberance. This is a health crisis. And until we solve that health crisis, we can't move forward. And unfortunately, we've already seen many businesses close down and go out of business, and many of those won't be coming back. The Congressional Budget Office recently came out with a report where they think the unemployment rate won't recover for basically a full decade. And I'm kind of skeptical that a vaccine will be widely available by the end of this calendar year. And there's also a possibility that we may never develop a vaccine. And there's an old saying that you hope for the best, but you plan for the worst. And I think we should start thinking about what policies we need to have in place if we're going to think now about what this might be if we are in a new normal.
Yeah, that's a question nobody wants to face, right?
No one wants to face it. That's exactly it, especially when an election year coming up. But we need to start thinking about what policies do we need to have in place if we're going to be asked to live under COVID for 1, 2, 3, or 5 years. What does that mean for policy? And instead of thinking just short-term gaps, let's start thinking about what long-term policies we may need so we're not, basically caught again flat-footed. And I think we're going to be in this position for quite a while, unfortunately.
So to what extent are the old jobs, the jobs that have been lost to this point, not coming back, and is the recovery going to happen in part because new types of work are going to be available or developed. Is that a factor here that might be different than other recessions?
Yeah, I do think when we see old jobs go, new jobs come in, but it takes a while for the economy to reassess and readjust. And for those old jobs, people who have those old positions to find new ones and get retrained. I don't know what they're going to be in. I don't know and think about the old jobs. A good example is movie theaters. When are you going to be comfortable, John, going back and to sit into a movie theater again? Is that going to be 2 months, 4 months, 6, ever? Or are you just going to watch things on Netflix and streaming from now on? And if those jobs go, I don't think we replace those. But what do those people who work in those industries do? Where do they go? I don't have that crystal ball to see what jobs are coming, but I also think we're seeing a change in the very nature in some ways of our work. That's not for everybody. And there's still some jobs I think need to be on site, but a lot of us have now been working from home. And I think we're fortunate enough that we can do so, that we're now seeing the ability to work from home and be more productive. But that still leaves a large portion of the population that can't. They're in service industry jobs. They have to be on location. And we need to think about what that means for their safety, for their health, and how that means for the economy, how we support them to make sure those jobs can still get done, while reducing barriers for entry for new jobs and new innovation and creation by small businesses.
So you mentioned that the stock market has essentially rebounded to the point where, more or less, like you said, the NASDAQ's had a record high, and more or less where it was before we went into lockdown. What's going on there? I mean, the stock market clearly doesn't reflect exactly current economic conditions, which of course is worse than they were 3 months.
We should point out that since the market's finicky, when we're taping this, it's at a high, and then given tomorrow, It could be at a low again, right? The interesting thing looking at the market is it's supposed to be a forward-looking indicator. And so in some, again, whether that you believe that or not is another question, but it's supposed to be forward-looking for earnings and not a reflection of today, but a reflection of tomorrow. When looking at the NASDAQ, what's interesting is seeing the stocks, the companies in that NASDAQ index that have gone up are companies like Facebook, Amazon, and Google that have done well under the pandemic. In fact, have done very well. I mean, Amazon was taking over before. I think now they're going to be, more than a major player. They're going to be a primary player. People are now used to ordering things on Amazon and having things delivered, including groceries, because Amazon basically is our ownership now of they own Whole Foods, and so they have delivery service for foods. So I think that nature is changing, and that's why you see the stock market so high. But I know a lot of people look at the market and say, how can the market be so high when you still have 14% unemployment? And I think part of that is a reaction where there's an expression of hope that there is going to be a vaccine sooner than I might think is possible. And you do see how the market tends to trend sometimes up or down a percentage point or two every day when there's new news that, there's been positive results from a new trial. There's negative results from a new trial. And it seems to trend that way. What I would say is what this is hopeful for is that people think the economy will recover. They just don't know when. And so I think the outlook is positive, but the timeline is uncertain.
Yeah. So let's get to sort of somewhat of a change of gears. We haven't looked specifically at deficit and debt numbers, and I was looking them up this morning, at least what CBO projects for fiscal year 2020 that we're in, and the next fiscal year. And we have numbers that we've never seen, but they're projecting a $3.7 trillion deficit just this fiscal year. That's it's not very many years ago, and that was the size of, really very few years ago, that was the size of the entire federal government and federal spending. And then debt is now over 100% of GDP, and so this is a change. This is a lot higher than we're used to. I learned in economics class that we should think about debt in relation to GDP. That it's the best way to gauge. That was the best way to gauge whether debt was manageable. Should we be concerned about this? What do you think about all this?
So I like the fact that you use the term manageable, John. I think that's a great framework for how we should discuss this, is whether or not the debt level we have, the deficits, are manageable for our economy today and going forward. And as you mentioned, the U.S. gross national debt, so I'm using gross national debt for the moment, is now about $26 trillion or 100% of GDP.
Right.
Our deficit is likely to be around 3.7 trillion, which you said, which is a result both of more spending, but also a reduction in revenue and a slowdown of the economy, so GDP is getting smaller. CBO likes to look at debt held by the public, which excludes bonds that are held by the Social Security trust funds, for example. And that's the number you quoted, which CBO estimates will have public debt to GDP about 101%. This compares with 79% at the end of 2019. And so you asked, should we be worried? And my answer is yes. Again, we haven't seen these levels since World War II. And at the moment, we're the global reserve currency. People still want to hold US dollars. We also have a lot of cash that's sitting on the sidelines. It's in bank accounts, money market funds. It's not circulating per se in the economy. It's just sort of being held back. And that's keeping inflation low. But at some point, I assume those dollars will come back onto the market. They'll be competing for goods and services, and inflation will come back. And it's also important to note in the idea of management, can we manage this, is that there are other countries such as Japan, which have a much higher debt to GDP ratio. They're over 200%. And Japan does not seem to be in any immediate danger of defaulting on their debt. But most Japanese debt is held by Japanese nationals. Where you look back at the Greek debt crisis, so much of their debt was held by foreigners. And a lot of our debt is held by foreigners too. So it's important to figure out whether or not we can sustain this level much longer. And I'd also just keep in mind when we have this discussion of deficits and debt, that you got to pay interest on the debt. There's an opportunity cost in these interest payments. And before the end of this decade, we're likely to see spending on annual interest costs of around $1 trillion. And $1 trillion a year in interest costs, well, we spend $1 trillion a year now on Social Security. We spend a little less than $1 trillion on defense.
That's
so
right.
The opportunity cost of paying for that debt and managing that debt will crowd out our ability to do other things, whether that's education, healthcare, defense spending, Social Security, any new policy proposals people want to bring forward. We're going to be paying interest on the debt, and that's at low interest rates. If interest rates start to rise, then that interest payments are going to rise as well. So I do think we have to be really concerned about the deficit and debt and not just gloss over it.
Because the old saw when you cited World War II as the last time that debt as a percentage of the gross debt as a percentage of GDP was over 100%. The old saw was, hey, at times of war, that's okay. And maybe that applies to a pandemic too.
So it's an interesting analogy and one that I don't want to put necessarily a war on the same footing as a pandemic, but I get where it's coming from. So in one sense, with a war, if you don't spend all the resources you need to win the war, then by the opposite is you lose the war and someone comes in and makes life very bad for you or kills you, in which case you don't want to be dead, you spend all the money you have. So a war is much different. Pandemic has been related to that, saying, well, if we don't get through the pandemic, we all could die. I'm not sure that's exactly true. It doesn't mean you don't spend money on the pandemic. And there's a sort of a war to try to get through it. But this is one in which a war can be won. We're not sure whether we're going to defeat the pandemic and find a cure for COVID. We may have to live through it. And it also doesn't mean that we should spend all of our resources just to make sure that this doesn't become something that's permanent if we can't fix it. And so while I do think it's important to spend money now, because it's the other analogy that I like better is a forest fire. The first goal of a forest fire is you put the fire out. The second thing is how do you pay for it? If you're sitting there squabbling over how to pay for putting out a forest fire, all of a sudden the forest is going to burn down. So I think in that sense, the pandemic analogy to a war does hold, but it can't hold to the point where you spend all your resources fighting a pandemic that you lose the opportunity cost of other things that are going on in the economy. And this is a discussion that's been had the last 3 months of whether we should have shut down or not. Should we have been more like Sweden, which stayed relatively open and we let people themselves figure out their comfort level in the economy? Or does the government force us to shut down and we basically trade lives for jobs? And how many lives do you save versus how many jobs, mortgages, retirement funds do you destroy? It's hard for people to put this in context. They don't like discussing lives. Some people say if you can save one life, that's just what you should do. But as an economist, we're not trained to think that way. We're trained to think about the opportunity cost and trade-offs that have to go into those saving those lives. It's not an easy and there's no right answer, but it's a discussion we should have. And that's in some ways the problem with saying the pandemic's a war, we should spend everything. We're not counting then the lost jobs, the lost, the mental health issues, retirement savings, people's careers or livelihood. Those are important too, and those should be part of the discussion.
Yeah, ultimately, it's a political question. I mean, an economist can measure, literally, perhaps measure the worth of a human life, but that's not what's going to drive the decision.
No, it's political, but it's also, I would say, a social question, because it's how do we want to spend our resources? And again, that goes down to politics, and that's what we're sort of having this conversation for, is for a political environment. But you have to be able to have an open conversation with society and the voters for them to be able to understand what we're actually talking about. And unfortunately, I think right now we see, sometimes one-sided media stories or one-sided discussions from different politicians, whether they're governors of red states versus blue states. The message seems to be different. And so we're seeing a hard time trying to have a conversation of the facts and weighing the pros and cons and the cost of doing one thing versus the benefits, and then having a reasonable discussion. And having a reasonable discussion and discourse is what this country is supposed to be all about. And it's getting harder and harder to do that without getting shot down or shouted over by one side or the other.
So getting back to the specific this conversation we were just having about deficits and debt, there's a lot of people, and it tends to be right now perhaps on the left who say we shouldn't worry about deficits and even really the debt then, because deficits lead to more debt. That they don't really matter. And I want to be even-handed, because some years ago when Dick Cheney was vice president of the United States, he said he didn't worry about deficits because they were big enough to take care of themselves. And so that he was trying to be funny, but the administration policy might have even reflected that view. So we've got people, maybe particularly now on the left, but really nobody's really saying, hey, let's balance the budget. So nobody right now is worried about deficits. Some people think it's just not something that we need to worry about. What's your take on that?
Well, I do think deficits and debt matters, period. That said, as you and I have already talked about, we do have a health pandemic. We do need to get it under control. And the analogy, I think, of the forest fire fits. When the forest fire is raging, your first step is put out the fire. The second step is figuring out how to pay for it. But there's no such thing as a free lunch. At some point, you've got to pay for the spending one way or the other, increase in taxes, reduction in spending, or you're going to have a reduction in economic growth if we keep borrowing and don't pay for it. Again, to be even-handed, I sort of see these discussions these days when people say, well, tax cuts pay for themselves. That's sort of this mantra you hear sometimes from the right. That is not true. Some tax cuts may pay for themselves. Most of them don't. There's also an inflection point that matters at where the rate is starting from. When you're talking about income taxes, capital gain taxes, corporate taxes, this generality that they all pay for themselves is foolish. On the left, this whole idea of modern monetary theory, that we can just keep printing money and it won't cause inflation and we can just pay for things that way without taxation or borrowing, just print money, is also foolhardy. And so we really need to have, again, a real conversation of going back into the opportunity cost of debt and making sure we pay for the things we spend it on and don't just kick it off into the next generation.
So you got into the question of the MMT, the modern monetary policy, because that's getting a fair amount of attention now at elite levels, at political levels. So I've read some things you've written. You mentioned that you don't think that although that may be a good description of what happens, it's dangerous to think that you can just print money to get out of your problems.
Yeah, I think history has shown us what happens when governments just print money. It leads to hyperinflation and the collapse of the economy. And I don't see that changing under any sort of current environment we have now. This sort of seems like everyone's trying to, depending on the problem you have in the current generation you're in or the current fiscal crisis, someone's trying to find a way to have their spending without paying for it. And again, I mentioned the Laffer curve and supply side economics, where they said you could just cut taxes and the growth will pay for it itself. Well, great, magic beans, this is all fantastic. Let's just cut taxes and not worry about it. The left's answer is now modern monetary theory, which says, don't worry about raising taxes. We just need to print money. Don't have to borrow it. We'll just print it. And we can pay for all these social programs we want. No inflation, everything's fine. At the two extremes, they're both wrong. We really need to have, again, that conversation back in the middle again about regular public finance and what it means to have deficit spending, who pays for it, what the distributional costs are, the interest rates, how it will eventually affect inflation, and what that means for economic growth, and what it means for the potentially lower economic quality of life for the future generations that we are basically borrowing today for our own consumption and putting those costs onto them in the future.
So once the economy is growing again, we hope sooner rather than later, what do you think needs to be done to correct course in terms of getting the budget under a more manageable place?
So you had mentioned the generous support of the Peterson Foundation for this. They also have generously supported a variety of think tanks to do budget exercises, including the Bipartisan Policy Center did one where I'm also a fellow. And pre-pandemic, several think tanks came out with various plans. And what was interesting is no one basically can balance the budget anymore. The amount of revenue you'd have to raise, the tax increases required to do so, or the spending cuts required to get us back in balance are now so draconian that it's not possible in a 10-year budget window anymore. At least I don't think it is. So what that means is we have to now have a longer term plan, 10, 15, 20 years, that gets us back into some sort of manageable debt to GDP ratio, maybe somewhere around 70% debt to GDP. And to do that is going to require both tax increases and spending reductions. And Washington's a very interesting place. Only in Washington, because of baseline spending, can you have a reduction and growth of spending, and someone call it a spending cut. That's not what we mean by spending cuts, but if we can find a way to slow the growth of programs and spending, and that over time gets us to a reasonable budget, then that's a good outcome. But again, that would be slowing the growth, not necessarily quote unquote cuts, but from a baseline, people consider that cuts. But we have to consider this because we just can't let it keep going like this. And we've also, the pandemic's a great example of this. We don't have the fiscal space anymore for the next problem we run into that was unforeseen. Maybe it's a second wave of the pandemic. Maybe it's a economic recession caused by normal economic business cycles. We don't have the fiscal space. At some point, people globally are not going to want to take our debt. And again, I don't think we can just print money. That's going to create hyperinflation. So we need to start managing our budget for the long term, also to create the fiscal space for expansions of programs, innovation, and to take care of what might be the next recession that comes down the road.
So let's wrap with the last question on what you think. And so here we've had 3 or 4 months since we were locked down in March, and the government has moved in certain directions with policy. What do you think is our missed opportunity so far? What do you think the policymakers in the Congress and in the administration have missed, and what specific things should they think about now?
So I think one of the things that's missing is a longer term discussion of what it means for policy if we are in this type of environment for the next 2 or 3 years. And that includes something like higher education and K through 12. If we can't have students back in the classroom for 12 months or longer, what does that mean for policy? If we can't have restaurants, bars, and businesses open, and we start seeing a massive decline or continuation of a lower revenue from sales taxes for state and localities, their budgets are going to be destroyed for a longer period of time. What does that mean for support? That's the sort of discussion that I think we're missing, is we're being so short term because a lot of people weren't sure how long this pandemic was going to last. When we first went into a shutdown, in some people's minds, it was 2 weeks, maybe a month. No one really was talking about us being shut down for 3 months, 6 months, or longer. And so I think that was the missed opportunity, was it was so focused on short term that we didn't have those long-term discussions. We need to start having those now.
Jason, I think you've done a great job of enlightening us on some of the issues we've touched on, and we want to thank you for being a contributor to our Conversations on the Future of Democracy series here at the Library of Congress. We appreciate it, and we wish you well.
Thank you. It's a pleasure being here.